Dividend investing remains popular amongst Canadians and most of my viewers of this channel. During economic bull runs like the last 12 years, dividend stocks usually underperform the market. Just check out the S&P 500 returns versus some dividend stocks. But as we enter a potential recession or stagflation in 2022, where unemployment is potentially high and there's slow economic growth, dividend stocks might outperform, especially the one I'm recommending today, which is a covered call ETF. I'm going to be recommending a 10% yielding ETF called TXF. Before we get started, I'd just like to point you to my Canadian Finance course. On May 1st, 2022, I'll be launching my first course called Canadian Finance Pro. I'll be discussing budgeting, credit, investing, stock market, investment accounts, portfolios, taxes, and at the very end, real estate and cryptocurrency are coming. At the launch of this course, there will be 60 videos, around 7 hours of content for beginner Canadians looking to learn how to invest, want to understand taxes, budgeting, basically everything Canadian finance. If you're interested, I'll leave a link for the mailing list. Anyone who signs up before May 1st will get a 50% discount on the course, just so I can get some feedback on what I can improve on, and then I'll continue to update the course. Not only will you get access to the course, you'll get lifetime access to the Discord and lifetime access to a Canadian Finance private Facebook group where you can chat amongst other people. Okay, jumping right into the topic today, I have a small agenda. I'll be talking about TXF. This is very high yield. I recommend it for anyone, I'll say anyone living off dividends or retirees, just because if you're not retired doesn't mean you don't want some additional income. This is perfect for anyone not interested in accumulation. So I'll say if you're young, 30 and under, I wouldn't necessarily recommend this, but again, to each their own. I don't know anyone's scenario. Everyone's a personal finance situation. This will underperform during a bull run. It should outperform during a bear market. And as we might enter a recession and stagflation. I really hope we don't, but it's hard to avoid. We'll see how this performs. This is a covered call ETF. Just note your return will be less than if you just held the underlying. And again, you see all these tabs up here. I will go into the returns of each. Let's just quickly break down TXF. The ticker is TXF or .to. It is 17.96 Canadian per share. Over the last 5 years, it has increased by 26%, just stock price. On top of that, you would have been earning a very healthy, I think 10% yield, but it varies, and we can talk about that a little more. This is the website. It is CI Financial, CI Global Asset Management, my apologies. So what this focuses on is tech giants. So they own 25 of the largest tech companies in the US, I believe in the US only. The management fees are super high because it's pretty actively managed and they have to sell their covered calls. And it's a 0.71%. So if you invested $10,000, $71 will be going to the management fee. This doesn't come out of your pocket. This comes out of the returns of the fund. So you don't necessarily have to worry about this. They call this a medium risk, which I agree with. If we talk about this, for those who primarily want US exposure in the technology sector, this is technology only, want the potential for high income generation. That is very important. Notice how they said potential. Want to receive regular quarterly dividends. Now, this isn't monthly, which is not ideal if you're retired, but the income is still pretty high and you can tolerate medium risk. So what they do is they sell at the money covered calls on 25% of the portfolio. So what I think should happen, if the underlying stocks continue to increase, you should be able to receive around 75% of the return, but that's not what I see with the portfolio. Something is missing. I should find out what happened to the remaining 75% if they're selling covered calls on only a quarter of it, but we can break that down a little more. The fund started in 2011. Let's just go over here. So growth of $10,000 since inception. If you reinvested all your dividends, you should have $40,233, but I don't think this is for people who would reinvest their dividends. I think this is for people who would live off of it. So the 40,000 might be a little deceiving. It just might not be relevant. Let's go into the performance. Is there anything important here? A little topsy-turvy. Understandable. Tech dropped in December 2018 at the very end, so it's understandable to see a drop here. Not important. Distributions, this is what I wanted to focus on. 10.19% in, what is this, April 2022, which is insane. But it's not stable. Just take a look at the distributions over the last few quarters. It is a varying dividend, obviously based on the premium they earn from the covered calls. If you're interested in learning about options, I'm not going to talk about it here. I release option videos. I release trading videos of me doing just live options, usually once a week if you're interested. I took just an Excel dump of all their returns. And if we look at their distributions, I kind of separated it out by year. So you see it's widely varying. And this is $1.77. And if we took the return on the current stock price, this is like 9.88%. And then you can see it does vary. So let's kind of go down over the last few years. Over the last 3 years where tech has shot up, obviously your returns would do really well. But then as we go a little further back, all of a sudden the returns kind of drop. Okay, so let's say this is deceiving because the stock price would have been different. So let's say the stock price was $15. So your returns vary. Obviously this shouldn't be 100% of your portfolio. If you're living off of this, you should use this to boost your returns in your retirement. You shouldn't use this to live off of 100% because the returns vary widely. If you started investing this in 2013, you're like, hey, this is a good 5% return. This is great. Then the bonus comes in the last 4 years where it goes up to 8, goes up to 12. Right now it's sitting at 10. Going back into the website, the portfolio, obviously it's all tech. The top holdings will be Apple, Intel. These are all stocks you'll recognize. Now, here's the thing. I don't own this ETF, but I do trade options on these underlying. So if you watch some of my videos, I have Apple, I have Nvidia, I have Microsoft. I bought recently before their stock split. I did end up buying Google and Amazon. So I'm doing something similar, but more aggressive to achieve a slightly higher return. If you're interested, I do feel myself trading. I won't talk about that in this video. So talking about the funds, is there anything I want to point out here? Nothing important. This is the top 10 investments. How risky is it? ETF can go up as well as go down. You could lose money. Yeah, that's pretty funny that they have to say that. So if you've reinvested your dividends, I do think they give a compound annual return. Yes, 16.3%, which sounds good until we look at the returns of the underlying. I just want to go through some other forms. There's nothing interesting here. So here's where they break it down. So writing at the money, call options on a maximum of 25% of the portfolio. So you're not missing on the entire upside of the underlying. Is there anything here? Not really. Cool. Let's go into some of the stocks they own. They own Nvidia. Now, over the last 5 years, I showed you this went up 26%, which is great. But they own Nvidia. Let's look at Nvidia over the last 5 years, 736%, which is insane. But let's say, hey, this is a one-off. This doesn't happen on every stock. Let's look at Google. Slightly less, 201. Let's look at Microsoft, 321. Texas Instruments, 117. Micron, 156. And lastly, Applied Materials, 184%. So these are just 6 of the underlying stocks. And you see they've massively outperformed. Or should I say the ETF has massively underperformed. Again, this shouldn't be for someone looking for accumulation over the long term. If you're looking for that, you should invest in the underlyings. You should invest in Nvidia. You should invest in Google. Let's talk about some of the downsides. I do feel it might be better if you do something like this. So what I'm trying to do here is illustrate if you bought the underlying and you try to receive the same dividend or the same cash every year. I hope this makes sense. So I took the the 5-year returns of 5 tickers. I didn't include Apple because it went up too much and I feel like it would just blow this out of the water. I did simple math just on the annual return. I'm not doing compound, just something very basic. If you invested in TXF, you'd get the 10% a year. And then your portfolio would be up 5%. You'd get 10% a year, your 1,000. Your portfolio would be up 5%. Again, your return, I'm assuming, doesn't go up with the portfolio value. I'm just keeping it very basic. We're looking at the 10% yield. At the very end of 5 years, the portfolio went up 26%, right? So you'd have 12,648 while receiving these dividends. Now, if you invested in the underlying, you want to receive, so you invested the same $10,000 in TXF. You did NVIDIA, Google, Microsoft, Texas Instruments, and Micron, so $10,000. But let's say you want to receive more money. So if we sell $250 worth to get $1,250, so an increased return over TXF, let's see what we can get our portfolio value to, assuming this is very basic math. I'm not doing anything compounding. I'm just saying, hey, if we take $250 out right at the beginning and we take our annual return, so in this case, it is 147%, what would happen? I think this should be something like, it should be like this. There we go. Come on, it looks like I'm just basically learning basic Excel. So again, this doesn't seem like much, but at the end of 5 years, while your TXF investment is $12,648, if you invested in these 5 underlyings, you should have $33,000, all the while getting a 25% extra return. Now, this doesn't seem like much, but what if we go $1 million and this is 200? Is that 200,000? Nope. So here, and then we go $25,000. Okay, hold on. Let me do this. So if we had $1 million portfolio and we put all of it into TXF, we'd get 100,000 a year, which is great. But if we invested in the underlying and took out 125,000 a year, we should be in a much better position. Now, this isn't perfect. I feel like there's a better way to calculate the returns, but it's hard to beat when you're at 700% gains. I didn't want to include Apple because it went up too much, so I want to include something that went up a little less. So that's why Texas Instruments and Micron are here, just to bring down the return of this. It's too biased if you just pick the best stocks. But yeah, this is an interesting Excel to look at just to see the variance. This is more work. TXF would be more peace of mind. Now, here's the thing. I brought up during a bull run and a bear market in the last 5 years, in the last 12 years, we've gone up by a record amount. Who's to say that will continue? So over the next few years, will TXF do better? I do think it will, just because the underlyings will be decreasing in price. So this will be losing money. If the underlyings go up, this will make money. If the underlyings go down, this has to go down. It's just the way it works. But you still should receive decent returns because the at-the-money covered calls they're selling should expire worthless. You should get a decent amount of premium. You might get even more than you're earning right now. During periods of uncertainty and volatility, premium income goes up, option income goes up. If you're interested, I do film myself trading. I can break that all down in a separate video. So this is a wrap up for my recommendation of TXF during a bear market, during a period of stagflation, which I think will hit soon. Now this is my agenda. I need notes or else I can't focus properly or I'll keep rambling. It is a good yield. Is it stable yield? No, but is it a stable dividend? Yes, means like they haven't missed since 2011, which is fine. A good 10 years to go by. It is good for retirees. If you're looking for overall accumulation of your wealth, I would not recommend investing in this. You should invest in the underlying stocks. Avoid the covered call ETFs. I think I'm going to leave it here. Let me know if you have any questions. If you want, please join the mailing list for the launch of my first course on May 1st, 2022, Canadian Finance Pro. Let me know if you have any questions. Thanks for watching and tune in to the next one.